Hello, everyone. Welcome to the third episode of Doc's Investing RX, where we diagnose your portfolios and prescribe the best remedies for long term financial health. I'm your host, Doc, joined by my lovely co host, Tron.
Hi, everyone.
All right, Tron, just introduce yourself to our audience here.
Yeah, so I have been in Afterhour for, I guess it's October last year. I've been investing for about 5 years now and getting to know stocks and jump into areas that I was interested in. And so from there, I was working as a curriculum specialist in a school district, and I started self teaching myself programming during COVID and moved into software development. And now I do software development and house building and investing on the side.
So, how's that housing market going right now? I've seen the news of housing sales dropping in
Yeah,
front.
it's not great right now. So I've shifted my original plan. My original vision was to basically build 3 to 4 houses at a time. The problem was now that we have a housing market where you might sit on a house for 6 months to a year. Now it's gotten to a point now where really, as a builder, I can only afford to do one house at a time. So right now I'm doing one home at a time. But what most people don't realize is the profit margins are actually pretty high for home builders. So we have a little bit of leeway there. So a typical home builder is charging 20 to 40% on top of the house price, the actual cost to build. Right now, I'm building one and just praying that the market gets a little bit better because these interest rates are not helping anymore.
So, you think it's primarily the interest rates? Because it seems like these rates have been pretty high for a while, but the market was running hot. What do you think changed things and turned things around here?
I think that it's more than just interest rates. Of course, it's inflation, right? The inflationary cost of everything has gone up. When I bought my first house, I bought a 1,700 square foot house in 2008 for 172,000, brand new. And now that same house, which I still own as a rental, would list for 295,000. So we're at a point now where everything's gone higher, but income is not caught up with the rising costs of housing. So as builders, we got to balance that. What do we do? Because everything's being also increased for our end too. So it's
Yeah.
a bad omen.
For me, I do have a mixed portfolio. So stocks is not my primary thing, but I also have real estate as well as part of my investment portfolio.
I think that's the right path to go by. You can't really have one horse in the race, essentially. If we're talking about stocks, we're talking about something that's susceptible to everything. The president changes, a war pops up. We have a cargo ship of oil tips over or something, and then our prices in our gas go up $10 next day for no reason, by the way. We can talk about that later. But anything can happen. And the same thing can happen in real estate, but it happens slower. The increase of pricing and the decrease of costs for land just happens slower. Now, as far as the reason why I own real estate, it's because I can take out loans on it for other things. For example, when I'm building a house right now, I use that my equity in that house to cover the loan for the next purchase or the next investment. And stocks are kind of limited, right? If you are in an IRA, you can't do that. Banks won't give you a loan based on a Roth or an IRA. It's got to be a standard investment account.
Yeah, I think the best you could do is margin off your shares, right?
Yep. And that I will say, interestingly, and I'm not going to recommend this to anybody. So anybody that listens to this, don't take this as the gospel. But in a lot of platforms, margin interest is actually cheaper than actual credit card interest.
Right. And that's an interesting point because if you look at margin interest, it is possible to negotiate a little bit of a lower interest rate depending on the size of your portfolio and your relationship with your broker. But typically, it is still pretty high. You're looking anywhere between 10 to 15% margin rate, but that still beats the 25% rates that you get with credit cards. So that is an interesting way to play it.
Right.
But in general, the fiscally responsible way to approach investments is to avoid excess debt. But as you've mentioned, sometimes being able to leverage certain debt and being able to capitalize on that can be a strategy. But the important thing is to always have a plan in place, right?
Yes.
Yeah. I noticed on After Hour, you are rocking a $232,000 portfolio after accounting for over $100,000 in margin. So what's that about?
Yeah. My port size before the big tariff talks, before everything went down, I had hit like I guess a record of 350K. And so what happened was my plan for Palantir was to ride it from 106 to 125, which it did actually run up there. So the plan actually worked out fine there. The plan, though, after that point was to cut the margin shares and ride out the remaining shares, take profit and ride out the remaining shares. Unfortunately, as we all find out eventually, is that sometimes you don't follow your own plan. And so once I hit that number, I thought, oh, maybe they'll go up some more. In reality, I should have stuck with my original plan, was which just cut the margin, but That's where we're at the moment. I've made some of that money back, but it's going to take a while to equal out with hoping that Palantir rises, hoping that Archer rises. I'm just kind of sitting in the margin right now, which is hitting me at about $15 a day.
Yeah, it's important to at least have a plan in place with margin, with credit, with debt. And it can be a great way to make money, but at the same time, it can be a way to lose money. And so I think it's important for anyone that decides to leverage, whether it's a leverage ETF, leverage with calls, leverage with margin, leverage with a second mortgage on a house, is that do you have a fiscally responsible plan on how to get out of it? And if things go the wrong way, you should have at least a backup plan on when to pull the ripcord.
Right. Now, I will say one of the things that you mentioned was really important is not have all your eggs in one basket. And so even though I have this margin debt, it's not really hitting me as hard because I do have a lot of other investments. I have other income sources coming in. And then I also have a lot of portfolio that are not connected. So I have other ports that are not connected to this one that kind of give me a pretty good backup, pretty good cushion just in case something happened. So what I'm saying is it's not worth the risk to take too much margin. But if you do, you better have a backup plan.
Yeah. And with the tumultuous week that we've had, it's been a wild ride. And it's led to a lot of people considering selling and bailing altogether. But I have been pretty persistent for the past several months in terms of reminding people to stay patient, to ride the waves. Because if you look at all the large whale investors with multi-million dollar portfolios, including some of the ones that we see on the Afterhour app, they are not entering and exiting positions daily. They seem to be riding and holding certain positions, believing in their thesis and riding for the long haul. And I don't know about you, Tron, but when it comes to my portfolio itself, it just makes more sense to plan for the long haul, figure out when it's a good time to add some more shares and just ride the waves versus trying to time the market, going in and out and stressing about each position daily.
Yeah, I think that we have a lot of investors that don't have a thesis. And I think that's something that's important. They don't have any kind of plan. And that's not me hating on anyone. That's just saying if you're going to take a big position, we really need to know who the company is, really know why we invest in the company and where we think they're going to be in 3 years. And if your plan is where they're going to be in 3 years, it doesn't matter where they are right now. That's kind of how I am with Palantir, right? Everybody knows that I'm pretty big into Palantir. And at the end of the day, my goal is to make money with them. And I do have a plan it's going to come to fruition, hopefully in 2 years, I hope. We'll see. But there's a reason why I invested in them a few years ago. And it wasn't because I thought it would be a get rich quick scheme. And I feel like often people want to bail on positions so quickly as soon as they see rough waters. Are we traders or are we investors?
Exactly, and it's a very difficult thing to trade because you honestly have to be on the computer staring at the screen, and it's just not healthy for most people because if you're emotional, you're staring at the screen and it's moving in different directions every so often, it's just not healthy for your mental health or your physical health. And it can really take a toll on people. And we've heard some tragedies of people falling into bad spiral and ended up taking their lives over it. So it's a reminder for everyone to take a step back and realize that investment, it's a great way to make money, but it shouldn't be a stressful experience. It's natural for the market to go up and down, but in the long term, it does go up. And if you're worried about your stocks that much, then you might have to reconsider what you're invested in.
Yeah, and I like that point. I like that point a lot because the whole reason for me that index funds exist are for the ones who don't want to worry about each individual movement of a company, each story, each news article. If you are someone who gets stressed easily by movement in the market, index funds are the best thing. SPY is going to always beat. SPY is going to beat me. Last year, I thought I was going to kill it. I did. Last year, I averaged 100 and we all averaged great last year. Let's just be honest. But last year, I averaged like 140% return. It was great. It was a great year. I was partying. I was ready to write my investor book, right? And now this year is a little different. It's a little different this year. And I don't have a lot of index funds, but if you did, like Sir Jack does, he's going to weather the storm pretty easily. It's not going to be as big a deal to him. He's going to see a 2% drop, 4% drop. He's not going to see a 30 or 40% drop.
He was doing single share YOLO investing, and he admits it was extremely stressful. And so now that he's reached his target point, he said enough's enough, and he has chosen the ETF route.
Yeah. And actually, that was something I was going to ask you about because that's important, right? I don't want to make this sound terrible, but once you hit $100,000, once you hit 100,000, it is much easier to get up to 200,000. It is much easier. And I'm sure once you get to 500, it's probably gonna be much easier to get to a million. I haven't gotten there yet. So I'll tell you guys later. But at 100,000, it's so much easier to make money than trying to get from where I started, which was like originally 6,000, 7,000. Trying to get up to 25,000 seemed like a mountain. And I think there's this temptation to go into these option plays just to get yourself up that mountain. But those option plays, man, they will burn you so quick. So I'm curious, Doc, how did you get to your point where you are at now?
Well, to just study that point, my favorite adage is get rich quick is getting broke quick as well. And for myself, I've been investing for a very long time. My first investment was just a small amount, probably $100, and it had to do with just a work plan that I did in college. And from there, I had to do school, grad school, and everything else. And student debt started to pile up. So I was more focused on just living cheap and try to minimize the amount of loans I took out. And then as soon as I started working, I got the first bill on my student debt, and I said, enough's enough. There's no way I'm going to be giving away this kind of money that you can't write off on your taxes. You can't declare bankruptcy. Student debt is one of the biggest scams in
Yeah.
America. And so at those interest rates, it's just piling on if you don't get out of it. So that was my primary focus. And I made sure to get out of student debt. And then as soon as I did that, I talked to a friend and he got me into investments. And so I just started putting money away. And I was really fortunate to have some really good investments early, including Apple and Tesla. And at one point, I had over 2,000 shares of Apple, over 1,000 shares of Tesla. And this would have been like pre splits, but I've lived through the
Whew.
volatility before. And I had a portfolio in the first Trump presidency. And needless to say, I got spooked. I sold a bunch of shares and I said, you know what? I'm going to outsmart the market. I'm going to go into options. I'm going to leverage this and then I'm going to bounce back and make this money back. And that's the thing. Revenge trading is a bad place to be. And so I ended up selling a lot of those shares, losing a lot of money. But fortunately, again, just getting back on track, staying disciplined, buying up shares and just focus on shares. And that's what I do. And I max out my retirement. I live below my means. I travel a little bit, but not much. I just do mostly road trips and just being very smart. I don't eat out that much and just being fiscally responsible and just getting back on track. I don't have a car loan. My mortgage is very reasonable. It's only a fraction of my monthly income. Yeah, just being smart, I think, really got me back on track and just getting out of the emotional aspect of it. With that said, looking back, if I just held on and held on to those shares, my portfolio would have been at least 2 or 3 times what it is now, but that's okay. Live and learn.
We're always going to have those moments, right? We're always going to have those moments where we thought, oh, this is a great spot to exit. And it wasn't the great spot to exit. We thought it was. And maybe it was for a few months, but long holding always seems to beat short term mindset almost every single time.
It can be a difficult ride, and sometimes, like you said, with Palantir, or in my case, I have shares in companies like Lucid and Moderna, where I have a long-term thesis in play, but the stock continues to go against you. As long as you're not being financially irresponsible, it's okay to take these kind of trades, right? It's okay to plan for these trades that you have a long-term thesis that are going to run through some difficult times. But if you're going to YOLO in specific trades, you got to be sure that you have an exit strategy that you will bail as soon as it gets weak, because the last thing you want to do is ride a bad company down to zero. I've done my share. I went that route with the meme stocks, and that's why I tell people that I'm focused on high quality, big cap names, and primarily my portfolio, again, being Apple, Nvidia, Microsoft. I'm looking at the market leaders, the leaders of the S&P index. These are the creme de la creme. And for me, I do keep a few of those tickers in my portfolio as reminders. I have companies who got delisted. I've had companies who are on their way to getting delisted, and it's just a bad place to be. And it's just not worth throwing your money away. Because I think when it comes to investing, you have to remember that this is your money and you're buying ownership of a company. And wouldn't you want to be an owner of a company that's printing money versus companies that are burning money?
Yeah. I'm curious because I actually, to tell you guys how I got here to where I am right now was Nvidia and Tesla. That's who I actually rode up the wave with. Nvidia, Tesla, Palantir. Those three were the only things in my portfolio forever. And which is a lot less stressful, actually. If I did that when I was doing that 2 years ago, that was an easy ride. There was no problems. I exited those because I saw some volatility with Tesla coming. It's just something about it where it is right now. It was just a little bit off for me. And then Nvidia, I just love that wave up. But then I started looking at the next best thing, right? Because it growth is going to be harder with Nvidia. With that in mind, so like I invested heavily into Archer, Palantir, and I've got a few more that I'm looking at. I'm curious, what's a company that you haven't really talked about that you watch closely?
So some of the companies that I think about are what I call my lotto plays. And these are the companies that have that potential for multiples expansion that you're talking about. However, for me, these companies also tend to have some negative sentiment around them. And so that's the only concern going forward because sentiment is part of the gateway to growth. But one of my big ones is Moderna. Moderna itself uses mRNA technology to create therapeutics. And funny enough, I actually invested in this company on the advice of no less Jim Cramer. And so this was back in 2019, so pre-pandemic. And he mentioned it on the show. And being a science guy I am, I read up on the company. It sounded very intriguing. So I bought a few hundred shares and it was $15 a share at the time and just left it in the portfolio. Next thing the pandemic hits, the thing shoots up to over $400.
Mm.
And so I was fortunate to sell some of the shares on the way up. And so I have made a lot of money on Moderna. And here we are post pandemic where it's come back down to now it's about a little over $30. But the pipeline is still there. They are still working on multiple meds, but that's biopharma, right? It is a crapshoot. It's a lotto. Fortunately, with Moderna, they have this proprietary technology. They just won the lawsuit against Pfizer for using that technology to build their own vaccine and make money. And so going forward, as long as they get through these phase trials of their cancer drugs and antivirals, including HIV, there should be a lot of money to be made going forward. Again, it's going to be at least 2, 3 years minimum, but I'm looking for that ride back up. The CEO just bought $5 million worth of stock for the first time since taking the CEO position back in 2011. So I'm very excited and looking forward to it. But again, it's a lotto, it's a gamble, right? This isn't my Apple stock, right? This isn't Microsoft or Nvidia. This is a much smaller company.
But
If this
if
is
anybody listens, they can easily tell that you have a passion for it, right? It's not just
right.
you've actually researched this company. It's not just you heard it on After Hour and decided to jump in, full port.
No, absolutely. And that's the big change in my investment strategy the past several years from my early years. Instead of going and following the masses, following what's the hottest thing that's spiking, if it's spiking, then you're probably too late. And so I'm much more disciplined now in terms of understanding what I'm investing in, understanding where I'm putting my money, and understanding the growth in the future and having a strategy.
I think that's important. I mean, that's that. And if anybody asks me about Archer, I can go through the same stuff, right? I can tell you that what they're working on, the colors of their seat interior that they're working on. I can tell you where the CEO came from, where the former CEO is now, which is not the same company, or one of the co-CEOs is actually at a different company. I can tell you everything about them because if you're going to put major money into these companies, you've got to know. But these companies that are lotto plays, you still got to know everything about them. Apple is one of those ones that's actually a little easier to just let do its thing, right? You don't have to know everything about Apple right now. You just let it roll.
And so I don't know about yourself, but do you ever try to keep cash on hand? I have a little bit of a rainy day fund set aside, but other than that, I'm pretty much all in on the market.
I don't keep a lot of cash. I'm same as you. I don't keep a ton of cash. I will every once in a while, but cash doesn't grow. Cash is a losing asset. Yes, I could put it into a savings account or to a high yield account, but I don't know. I see more value in having my cash in the market.
If you look at cash itself and having it on the sidelines because of the risk of inflation, your cash does depreciate in value. And it's the craziest thing to think about, but your $1 is depreciating at 3% a year. So having cash on the sidelines or cash under your mattress is not an investment strategy. You are losing in that aspect. And so at the very least, investing in something simple like VOO or the SPY is a way to make sure that your money continues to grow. When you average 10% returns, you offset that 3% loss from inflation.
Yeah, and for about 3 years, I had a savings account with about, I guess, about 60K in it. And literally in December, I was like, what am I doing? I actually said it to myself, I was like, why am I sitting here? And I think the bank was giving me like a quarter of a percent. something awful, something terrible. And I said, what? Why am I sitting here on this cash? And that's when I moved it in the market. It's in the market now. It's not a great time to be entered the market, but it'll get better.
That's right. You can't time it. We're going through ups and downs. During these down times, if any new money's coming in, I'm just putting it to work and buying up what I can. And so I did put up a list of the stocks I've been looking for. And it's funny because literally maybe about a month ago, I put up a post of companies I was watching and the buy zone that I was looking at. And sure enough, here we are with those companies in those buy zones. And one of the big ones is Broadcom under that sub 200. So that 180, 200 level is something that I'm watching. Meta pulled back quite a bit. It actually hit $600, which is insane. And the other stocks, of course, Nvidia and Microsoft, a lot of these stocks have come down quite a bit and they're very intriguing range. And I look at it and say, sure, these can pull back a little bit. 10 years from now, is that 2%, 3% difference in price going to make a drastic difference? Probably not, right? I'm not going to notice it. I'd rather be in it than miss out on the opportunity.
Yeah. And I'm sure you had those ones you didn't take the opportunity, right? I don't know this, but do you have currently Palantir? I haven't looked at your report in a little while.
So I have a love-hate relationship with Palantir. My first purchase of Palantir was back when it was $24 a share, and this was after it pumped to 45 and then pumped to 35, and so it was down to 24. So I thought, you know what, this is a good time to buy. It's pulled back quite a bit, and I put in $160,000 worth between shares and options on Palantir. And
Oh,
the next day or two, I was up probably 8,000 bucks. And so I was feeling pretty good. And then next thing you know, it continued to tank farther and farther along. And once it got down to $7 a share, I said, you know what? I'm tired of bag holding this. I'm going to move my money into other stocks. And sure enough, it kept falling. It actually went down to $6 and some change. And I felt like a genius. And then for some reason, the market changed its sentiment around Palantir. And the earnings continue to grow, but not to the point where it deserved these multiples, right? It went from $6 to 40 and the growth wasn't 7 times, right? So for me in the back of my head, I said, this thing is just bloated and it's going to come down. And as continue to have that momentum, finally, after this giant pullback from 120 down to 80, I picked up options. So what I'm doing is I'm swinging the $100 strike point for April, and I'm looking to probably exit in the next couple of weeks. So I'm waiting for a big move back up. But in terms of holding Palantir, I just can't do it. And the primary reason is that I'm an anti like war stock type thing, right? So
hmm.
because of what WTF, I picked up Boeing and I was back holding that and finally broke even and bailed on it. And I felt disgusting. I just hate these companies and it's blood money. And I was so glad that I got out of Boeing and I know it's undervalued, et cetera, but I'm out and I'm happy. And with Palantir, it's the same aspect. They make money based on war and military, and it's just something that I don't want to profit off of. And so I'm just in it for a short term swing. And I just figured if I do options, it's less filthy because I'm not buying in the company itself. So
Yeah.
that's the way I'm looking at it, but it was just a small gamble. I think I probably put in maybe like 12 or 13 grand in it.
It's hard to be, it's hard sometimes as an investor to also put aside your like moral compass to make these buys. And I get that. Actually, when I first bought Palantir, they didn't really do much for the military. It was actually more on the logistics side of shipping and receiving. It's how they started shipping and receiving logistics. And that's when I first bought them. And actually, I know that $6 price point because I got it at 30. It went to 6 and I just stopped investing. I just deleted the Robinhood app from my phone. I didn't touch it. I was just like, I'm done. I'm out. I'm not like selling out. I'm just like, I don't want to look at this anymore. And then I was on Reddit one day and it was randomly like, it was like, oh, Palantir just hit $40. I was like, say what? So then I was like, I was back in. I was back in the market. Now at that point, I had Tesla, Nvidia, and they all just decided we're all just going to grab hands and just rise up together over the next 2 years. And that's what they did. It seemed like they just, because over 2 years, all three of them just became juggernauts. Now, I will say that I'm looking at other companies now. I'm like Tesla was one of those companies I just loved. I just adored Elon. I'm just full transparency. I adored his early Elon when he was talking about going to the moon, electric vehicles. That fit everything that I liked. And now I'm starting to see that more with Rivian. I'm starting to see that those vibes, those earth, nature, like I'm seeing those vibes with Rivian and I'm starting to like it.
I think there's something to be said when you're sleeping on the floor of your factory to make sure that everything's running right to now to completely be uninvolved in your company as a CEO really says something. And for myself, that's a big red flag for me of why I can't recommend Tesla. And I still have my shares. I still actually have a share that I held for the past 10 years that's now turned into 15 shares because of the splits. And my average cost, I think, is about $10 or so. But I just can't recommend it. It's one of those companies that's a toxic company because your CEO is just completely uninvolved and doesn't really care about it. So with that said,
It's
is
painful,
there value?
painful,
Yeah,
right?
if you're a Tesla shareholder, you have to look at your long-term thing, and I know that everyone's hyped up about robots and AI and so forth, but there's a lot of companies out there, and so I like Rivian, and I'm a big fan of Lucid as well. I think there's gonna a lot of competition now in the electric space, but it's nice. It's good for the consumers, and I'm happy that everyone's got options now. But you have to be very smart with your money and where you put your money at, and you want to give your money to someone who's focused on returning value to you, right? Focused on the shareholders. And when your CEO is not focused on the shareholders, that's a red flag for me. And so can't really recommend Tesla anymore. Again, Palantir, because of the movement into the military space, I do see a bright future for the company, but whether I want to be a long-term shareholder still remains in doubt. But for now, I'm focused on Nvidia, on Apple. I think Nvidia itself, the AI, data centers, the chips, everything, everyone's using AI and everyone's needing Nvidia GPUs. And so for that reason, I'm going to continue to ride that wave. It's been a rough 7, 8 months because it's just been very stagnant, but I still stay very bullish on the company. Once things get turned around, we should bounce right back. Even with the trade wars, Nvidia should be just fine.
Do you know want to know one of my interesting theories about NVIDIA? Because I actually love NVIDIA. I
Yeah,
have
what is
like
it?
my PC next to me is just full of NVIDIA. So NVIDIA was invested in SoundHound, correct? Like they were big into SoundHound. That was one of their big holdings. And they sold off their SoundHound investment. And I was wondering, why did they do that? Why did they sell off their SoundHound? But then I started looking at their website and I realized that they have this whole section that I didn't notice before that dealt with their voice AI. So I was like, did they sell it off so that they wouldn't be investing in a competitor? Which is not a bad thing. I don't want to, they didn't steal tech. They just developed their own tech, but they don't want to invest in a competition, which is what I would expect from a company. But then looking at their website, and I started noticing they have a lot more areas on the AI side that have been filled in since their presentation in January. I do think Jensen is so smart that he is thinking 10 to 20 years in the future. He's not thinking about today because today's important, but 10 to 20 years is also important, which is what he did before he got the AI revolution. So I think he's going to, as market share gets taken or as AI models require less computational power, I think he's already thinking what is next for NVIDIA. And I love the direction they're going. They're thinking about cars. I find it hilarious that Elon is spending billions of dollars for data centers, which are good data centers, but I find it hilarious that he's funding his competition because NVIDIA is now working on their AI driving software and that Rivian is going to be one of the first customers for their AI software for driving.
I was gonna say Tesla bought NVIDIA chips for their first generation autopilot. So this was back in 2015. And so that's actually why I invested in NVIDIA to begin with. And then Tesla said they were gonna make their own chip. And of course, I sold NVIDIA at that point, and that was a very stupid move. But I agree with you. I think that Jensen Huang is very locked in on the company. He's locked in on the future. He's been founder and CEO of the company since he started it, running it on a paper napkin in a restaurant back in the early 90s. And here we are as the second largest company in the world. I'm very excited to be part of that journey, and I'm looking forward to the long term future with NVIDIA.
Do you plan on switching to index funds and ETFs at some point? What's your end goal? WTF's portfolio size? Is that
Yeah,
the end goal?
it's very intriguing. So I have a friend of mine who was an early investor in Apple and Nvidia, and he just poured money in. He just kept pouring money into these stocks. And we're talking about maybe 15, actually more than 15 years ago. And so he is worth over $100 million now. and it was on the backs of Apple
Mm.
and Nvidia. And I asked him about his strategy and changing, and he says he's not changing anything. He's continuing to ride it. And, you look at different aspects of wealth accumulation and so forth. If it's working, why change it, right? I think going into the older years, it's definitely worthwhile to consider being more conservative. And so I think everyone should have a basket of VOO no matter what age you are. But once you have that basket, you just don't touch it. And then you can go ahead and start branching out into individual stock picks. And so what I'm looking at in my portfolio is to let it continue to grow. My goal is to reach that sort of $10 million mark, and at that point, then I'm gonna start focusing on building up that VOO versus buying individual stocks. But I think I'd continue writing those stocks for as long as they go, unless my thesis changes, right? If Nvidia starts to fall out of the top spot in the S&P, if Apple starts to fall out of the top spots in the S&P, then that would be time to consider. But if the winners keep winning, why would you divest?
I really want to buy more into Nvidia because I do see a bright future for them. In a perfect world, I wish I could buy leaps that were like 5 years out. I wish I could really buy them way out there. So I could do that with a few companies, but I can't. So with that in mind, Nvidia is one that I plan to add. And then with Rivian, I've got currently holdings of something like 2,500 shares. If Rivian can prove to me that they can launch this next version, this affordable variant, then I'll probably double my position to 5,000 shares but I want proof. And this is part of that dollar cost averaging. I want proof they can do it. That's where I'm at right now. But what is your exit? So your exit plan, what was that amount? So do you have a magic number to when you reach a certain age? I have mine.
And
Mine is 5 million.
let's see, no, I'm more aggressive. I'm shooting for the $10 million mark.
I'm in the South in Mississippi. So for me, 5 million is probably 10 million where he is. Our cost of
That
living is lower.
that's actually a good point. Once you account for taxes and everything else, it does eat into all of that very quickly. At least my thought with the $10 million is that at least the money will continue to grow. You can withdraw easily from that account, 4%, retire, and be very comfortable. And so you just don't know how the market's gonna react. But for the long term, for the long haul, it's just, being a patient investor. And we talked about leveraging money. I think when you talk about leaps, that's another way to play it. You can buy deep in the money leaps, and then that way you can leverage your money going forward. So you're still playing options, but in a much more conservative fashion. An example is Nvidia. I have $50 Nvidia calls. Now, these ones expire in June, so I'm coming up to the point where I need to either exercise them or roll them out or sell them. And that's another way to leverage your money and work with that. So just another idea for our listeners to consider if they're thinking about how they can leverage their money.
Yeah. So you right now are not looking right now heavily at those high growth plays. You're looking at more stable growth, like consistent growth every year. That's kind of where you're at right now.
Yeah, I think with my portfolio size itself, that I'm moving on to the next phase, which is to be a little bit more conservative. I'm trying to avoid the meme stocks, right? I'm trying to avoid the pump and dumps. So I want to be sure that the companies I invest in are going to be around for a long time. So again, I told you about Tesla and Apple, and if I just stuck with them, my portfolio would have been multiples of where it is now. And so again, just investing in solid companies does pay off. We talked about the S&P returning 20% the past couple of years, right? And if you just look at
Mhm.
Apple and the return it had over the past year, it's returned almost 50%. So it went from 160 to 240. So that's incredible. That's huge returns.
Yes.
So that's why for me, it's the top company in America and it's the top company in my portfolio. Investment are very tough. It's a very tough field. Warren Buffett had a very famous challenge to hedge funds, and if they could beat the S&P, he'd, I think, give them $1 million, and nobody was able to win it. And so trading can be very difficult, but investing is just a very much easier way to gain wealth. And I think for 99% of people out there, that's the way to play it. It's hard to jump on call outs and about in and out of trades unless you have nothing to do and you're able to sit at a computer and stare at the charts. But that's really just not a healthy way to live. You got to go take care of your family, take care of your health. You got to take care of the bills, right? You got to get a consistent source of income. I caution anybody that jumping into these things to always be mindful. Don't play with money that you can't afford to lose. When you have a large portfolio, and I think WTF is one of those characters in the community where you can look and he can lose 10, $20 million from trades. Again, when your portfolio is that large, you can easily make it back up again.
Doc, one more thing I'll give you. I would ask you since you mentioned that. Do you think we'll ever find out what WTF's actual identity is?
I'm not sure. I would love to have him on the podcast and find out, but we'll have to wait. The whole middle school personality can only work for so long because eventually he's going to have to graduate.
Yeah, I think it would be funny if he came on your podcast and had a voice changer, like one of those old school like 1990s voice changer when it gets really deep.
Oh my gosh. Yeah, no, that's right. It's the talk boy from Home Alone. That's what you're referring to.
Oh yeah, no, that would be pretty epic. After Hour is, I'll just talk about the app for just a second, is an amazing app. I'm a software developer, so this is what I do. I look at it, I look at what he does, and it's not the most complicated app. It is from the sync standpoint, but from the front end, it's not the most complicated app, which is fine because the app doesn't really matter. The community that's been built from referring from Reddit is actually the power of this app. The community is what makes it what it is. That app could be copied by someone in maybe 3 months, but it doesn't matter because they won't be able to build that kind of community. You're not going to get those kind of people there that are actually sharing those ideas. And now that he's got this core base of heavy users, I could see this thing go to 1 million users. I'm not even exaggerating. I could see it being huge. I'd invest. I'd invest in the
Well,
app.
yeah, we'll have to wait and see where the growth is because it really comes down, like you said, the personalities that you get. And I'm starting to notice a few more trolls compared to a year ago. But again, with growth, you get these issues. But we'll see where it goes. And I got to say, Tron, it's been a pleasure having you on the show. And thank you for taking the time out. And love to have you on a future episode.
Definitely. I'm all in.
Excellent. All right. That's a wrap on today's episode of Docs Investing RX. Tron, thank you for joining us. If you enjoyed this episode, be sure to subscribe and let us know your thoughts. And if you want your portfolio evaluated, reach out to us. Until next time, stay smart, stay patient, and keep investing wisely. Thank you.